Now the market's up and down again, enough to drive you around the bend. Bonds and stocks got you singing the blues. Well, sister, we're here with some mighty good news. Ba-da-da-da, talking real money to clear up all your worries. Tom and Don will see you through. Talking real money, that's the thing to do. Talking real money.
Ladies and gentlemen, that in honor of Tom's obsession with the 1940s. Yes, the World War II era. The Andrews. No, those weren't the Andrews sisters.
Sounds a little like them. Could be.
Sounds a little like them.
Yeah.
I just write these prompts. This is what I do.
One is good. Whatever
I
you
write
wrote.
these prompts, and then I listen, and then I rewrite it, and I write some bad lyrics, and I know they're not the greatest lyrics. They're thrown together in like 20 minutes, so I'm not a songwriter. But this stuff comes out flippin' clever.
Yeah, and you could put that on a 78 and then play it on a swing years program and get away with it, I think.
I'm
Good.
I don't know about the rest of you, but I'm entertained. And if you're not entertained by your own podcast, well, who will be, really?
You're going to laugh at your own jokes, too?
I do. I laugh at you laugh at your own jokes.
Nobody else does. That's why. I got it.
You I forgot what the word is. You cynic,
Non-comedian? Yeah, okay.
You
got it,
contradictarian. I don't know what.
Contradictorian?
Contradictor. You contradictator.
That's probably pretty close.
That's pretty close. Hi, everybody. Welcome to Talking Real Money. Talking Real Money. We are going to talk about something really different today. I don't think this is a subject we've ever done in like 2,000 episodes. The topic today is 3 funds, 1 decision. How do you pick among 3 very well diversified exchange-traded funds that we discuss a lot on this program? This was a suggestion from a rabid listener who said, what is the big difference between these? So, ladies and gentlemen, Tom Cock has gone out and done the hard work so you don't have to, and he has explored all the ins and outs and ups and downs and sideways and so forths of 3 funds: AVGE, DFAW, and VT. These are all total market funds, one from Avantis, one from Dimensional, and one from Vanguard. So what are the differences?
I got to give full credit to Craig, who's a loyal listener, very loyal. Thank you, Craig, who did some digging on these as well. He sent over some research he had done as well. So it's really great stuff. This is a fascinating topic. And we have a question that revolves around
you
this.
You say
too,
that about all our topics, by the way. This is fascinating topic.
Wait. This is a really fascinating topic.
Okay, whoa.
Pay attention. Yeah, because here's the thing, and we have a question about whether or not it makes sense to just use a fund, or why do advisors use, 10 to 12 funds in a portfolio?
Well, that's later in the episode.
Yeah, that'll come up. So AVGE, as you said, is the Avantis Global Equity Fund. DFAW is the Dimensional Funds Global Fund. And then VT is the Vanguard Total World Index Fund. So I guess at the end of the day, before we'll cut to the chase, these are all 3 very different funds. I don't even know if you can actually compare them in many ways.
See, I find them very similar, but different internally. Their structures are, but in terms of what they are meant to accomplish in a portfolio, their purpose is very similar. It really depends on, hey, guess what? Depends on you.
Exactly. Thank you.
The final choice is going to end up depending on you.
Yeah. So Vanguard is an index fund. It
Pure
holds,
index.
Yeah. The global basket of 10,000 securities. You get that at 0.066 basis points is what we call it in the industry.
0.06 of 1%.
Yeah. And so it's designed to give you exposure in one fund at a very low cost, the Globe. Pretty good fund. And by the way, it's done well in terms of performance. We'll compare all of these, but their performance is very similar. There's only a couple of years to look at them because they haven't been around that long. VT's been around longer, but AVGE and DFAW really only about 2.5 years, so a very short period of time. AVG a little longer, but DFAW. So for to give
Well,
you
it
an
just took
apples-to-apples comparison.
Dimensional a little bit of time to convert everything to ETFs, whereas Avantis started off as a pure ETF house.
And remember that the products are, we'll get into the specifics here in a minute, but they're, for the most part, they're fund of funds. So these own other funds inside of them to give them that diversification.
DFAW and AVGE, not
Correct. Yeah. Not VT. That is a solely operated fund on its own. But anyway, okay, so you're going to want to know which one's made more money. You're going to want to know which one's cheaper. I know because I talk to you people all the time. It's well, how much is it? And I don't want to spend any more money than I have to. We love that. And which one's made more money. Here's the reality in terms of the performance, because this is the thing people go to first anyway. For that 2.5-year period that you can examine them side by side, right, 24, 25, and half of basically 26, AVGE has made a total return of 50%, VT 48%, and DFAW 47%. That's not appreciably different in any way, sense, or form.
Yeah, but and that's such a short period.
It's very short. But here's the thing about that. You could clearly say that you can kind of reason why AVGE's made more in that period of time. Let's talk about AVGE for a moment. First of all, when it comes to, remember, AVGE and DFAW are what they call factor-based funds. So they invest more in smaller companies. They invest more in value. They work with things like profitability, right? Momentum. There's things inside the fund that are different than a pure index. Those things, those particular parts of the market have done better than what VT owns more of, large sort of growth companies over this 2.5-year period. That's why AVGE, which by the way is 23 basis points compared to the only 6 you pay at VT, has made more in, as Don said correctly, short period of time. But even when you boil that down, there's differences. So Dimensional, for example, and thank you, Craig, for he provided this up front. I went back and looked to make sure it was right. But DFAW, for example, has a different look at profitability than AVGE, in case it's not complicated enough. They look at fundamental accounting, whereas Avantis looks at cash accounting. So they don't include accrual. These are things I don't think you need to worry about, right? The idea is they're exposing you to a factor that has shown over the long haul to provide a little bit of additional return, right? It's fascinating, though, that these are considerations by some. DFA has a different look at their core factor exposures, and this again came from stuff that Craig found. Thank you again for that. To reduce turnover, they don't want to move the portfolio around very much. Avantis more aggressive in their tilting. Remember, tilting is more to small, more to value, more to profitability, more to momentum, some of these other factors. None of those things would surprise you to know, because Avantis is the up-and-comer. They've been the one, they're the rival, if you will. They're former people from Dimensional, so they've been doing all that. Again, when I look at all this, and let's see, so I gave you the DFAW, by the way, because just to give you the cost comparison again, AVGE at 23 basis points, DFAW is 25, a little bit more, and VT at 6 basis points.
Here's another really interesting fact, though, that I discovered in looking at these three funds. The Vanguard Total Stock Index, you'd think that was the total global stock market. You'll just listen to these numbers. VT has just barely over 10,000 stocks in the portfolio as of its most recent report. Okay? 10,000. AVGE, the Avantis Global Equity, has 11,500.
11,000, okay.
11,500. DFAW, 13,700.
Yeah, and so but
do you know what the difference is? What is the difference?
Hundred.
What does VT leave out that these other two put in?
Which asset class?
Mm-hmm.
I don't know that.
Frontier markets. And
let's tell people what frontier markets are.
Frontier markets are the below emerging markets.
Yeah, you can't even
Nigeria could be a frontier market.
And who has those? The
DFAW and AVGE.
Not included in VT, which some people could call more conservative as a result of
right.
that. Yes.
And the other thing is microcaps. VT limits itself to small caps. Micro caps, I don't even remember where the break point is for micros anymore. Is it 10 million?
10 in terms of the
10 million capitalization.
Yeah, small.
So what's really interesting is that tells you that VT is a much more conservative fund. That also explains a part of the difference in the fee structure, because buying stocks in emerging or in frontier markets and microcap markets involves larger spreads, higher costs of trading, just trading costs in those markets. So it's they're different. You're right. I mean, there's a pretty big difference.
They're not the same funds. Yeah. So this is, you said it correctly 10 minutes ago. This is really up to you. If you say, I just want to own the globe in an index, VT is your best spot.
I want to own the safer globe in the index.
Yeah, it's more conservative. If I want to have, some exposure to the factors, if you will, then I would say it's DFAW. If you want to take a little more risk, right? You want to own, and by the way, it's interesting that AVGE still owns more stocks than VT. I would love to know the percentages in each one of those asset classes, because I bet you AVGE still owns more small value and internationally small value.
They do. Of course they do.
All those things. So it's riskier. It has to be by owning those securities.
This is why I keep saying we could just end our show if everybody understood this one premise. We would never have to do another podcast about investing, ever. One premise. DFAW and AVGE, Dimensional and Avantis, are sold based on higher expected returns based on academic research. Why do you get higher expected returns?
Only one reason.
Higher expected risk.
Yeah. You've got to live with greater volatility.
And that applies to the entire world of investing. All you have to do is look at what is the promised or expected return. If it's higher than this other safer product, then it's a riskier product. In one way, shape, manner, or form, it's riskier. If it promises more or delivers more, you may not see the risk yet, but you probably see it someday. But it is more risky. I guarantee that. That is the one thing I can guarantee, is that an investment that pays more and is expected to pay more must somewhere have more risk affiliated with it. Sorry, that's the way it works. You can't have your cake and eat the whole thing and it still be sitting there on the counter.
I'm going to eat it. So to go back to where we started.
Because it gets stale if you just leave it on the counter.
It won't matter to me. If go back to where we started, you're going to ask us which is the best single fund solution. Mm-hmm. And I'm going to say, and I hate saying it because it's Don's line, it depends. It depends on who you are, what you're trying to accomplish, how much risk you want to take, and what kind of portfolio matches up what you're trying to accomplish. Mm-hmm.
Which brings us back to our other simple rule for building a portfolio. Know your risk profile. Because once you know that, then you can answer the question, how much risk can I stand taking? But the even bigger question, how much risk do you really need to take?
Yeah.
If you're set, why are you stretching for higher returns when you don't need them?
Yeah, I think that's really sage advice.
Is it you want to die with more money? Why? You'll be dead. No matter where you go after you're dead, no matter where you believe you go after you're dead, you're not going to be taking money any of those places. There's no afterlife bank. There's no in the ground bank. There's no reincarnation bank. Whatever your belief is, no one has taken their money with them.
Yeah, or unless it's the final episode of Outlander and you might be dead, you might not be dead. So
I haven't watched Outlander. I got to convince Debbie. It's a good show. You sure?
I enjoyed it. Yeah,
okay,
and I'm pretty cynical about time travel.
You are. I am too, a little bit. The time travel things. I like science fiction, but the time travel, because I know time travel can't happen. It just is physically impossible.
Yeah, there's the time-space continuum. And by the way, thank you, Craig, again for this topic suggestion.
Guess what time it is? It's Talking Real Money question time.
You had me going there for a
No,
moment.
I won't. I won't.
Yeah.
I won't do another question.
This question goes right to the heart of the matter that we just discussed from Matt in Hyde Park, Utah. He says, Don and Tom, greetings. First and foremost, thank you. I've loved the shift to podcast only and no advertisements. Wait,
I know I killed all the ads.
Anymore? Okay.
I killed the ads. They were annoying, and
Made me feel important, though, to listen
they
to
weren't
the ads
making
today.
much money, so nobody missed it.
Such a nice listening experience, he said. I also hope you don't push the podcast to 20 minutes, as the 30 to 40-minute episodes are even better. Okay, you're just
We're
a
shooting
glutton.
for 20 to 40.
yeah,
we
you're just a
we usually
glutton.
end up right around 30.
Yeah.
But we're not going to time it. It's however long it goes.
Yeah, that's true. I've told you this before. Your podcast is my favorite, and I look forward to it every weekday.
Yay.
Matt, we got a doctor we're going to take you to go see. All right, here's my question. You guys suggest one fund solutions pretty often, such as VT or AVGE. I agree with this wholeheartedly. I personally have a 3-fund portfolio of U.S., total international, and AVUV small value. I've been tempted to go to a 1-fund, but my frugal side can't get past the expense ratio issue, as my current 3-fund portfolio has an expense ratio of 0.6. If a 1-fund solution is such a good idea, why do financial advisors tend to add multiple funds? I know a few advisors who don't do this, but most do. I bet you guys at your firm have an average of 6 to 15 funds in your portfolio. Please
Yeah,
correct
we
me if
do.
this is inaccurate. It seems the main reason advisors do this is to make themselves look more intelligent to their clients and lead them to believe that portfolio management is complicated, which it is not. I'm guessing the outcomes of one fund portfolio and 10 fund portfolios often close to the same. Rob Berger, your YouTube truth teller, says that you would manage a $10,000 portfolio the exact way as a $5 million portfolio. I tend to agree with him. What say you?
Okay. Whew. Good question. Good question. A lot of stuff in there.
Thank you. I can take
One
a breath.
thing that I want to question myself
Yes.
is your 0.6%.
That's
Was it
hard
six?
to-
No,
I-
did he say 6?
Yeah, 6 100s.
6 100s. No way. I'm sorry, but there's no way.
Yeah, I don't know what those three funds
Because
would
if he has AVUV in there, that's 25 basis points right there. So that's
Bingo.
going to skew the number up. If he has an international and a U.S., the international is going to skew it up a little. I don't see how, unless everything is in just like VT and a little bit of A. But even then, it can't be 6.
be. No, it can't be
100.
6 because you
Can't
got
be
the
6.
23 in there anyway.
Whatever. That's just a quibble.
Okay, fine.
That's a quibble. All right. Here's the deal.
Yep.
If you overweight things like value and small and other factors like profitability and momentum and things like that, you really get in and you tweak over and above what DFA and Vanguard are doing based on each individual's risk profile. There is actual evidence, by the way, from Vanguard and from Dimensional, that shows that your expected, based on the past, return might be a few basis points higher in each of those things. And then when you add it all together, that becomes several basis points higher, which when you have a larger portfolio, which is what most people who deal with an advisor have, usually you're in the 7-figure area when you're dealing with an advisor now, that starts to become real money, these little tiny incremental bits and pieces. But you're right. There is a portion of earning your keep to that, I think, a little bit. I think there is a perception.
There's other things to consider, by the way.
Oh, there are lots of
one.
things to consider. It's actually managing money is complicated. It's not
Tax
just
loss harvesting,
right. There you go.
which you really can't do with one fund. But if you have many funds, and some have done this, and some have zigged, and some have zagged, and you can book losses, that can be important, especially if the portfolio is larger than $10,000. Number 2, there are things you can rebalance better with using more than one fund, right? Because I'll give you an example. The last year, so I imagine that, and I didn't go look at the rules, but a DFAW, for example, it probably rebalances the portfolio every few days, weekly, something. In other words, if anything's out of sync in what percentage it should hold in the portfolio, it's going to
It's
sell that.
immediately changed.
It's changed. Conversely, a professional managed portfolio may let those winners run a while longer, and then the momentum that you get from that adds to the portfolio value. So that
And by
can
the
work
way,
in your
they
favor.
adjust essentially daily.
Okay, as well. I knew it was very quick. So that, again, you're right, Don. We don't know what the future holds, but in a general sense, that rebalancing ability probably pays off in your favor.
And actually, if you really want to read a detailed explanation of this and a number of other factors that make hiring an advisor make sense financially, go online and look for Vanguard's Advisor Alpha paper and read the whole study, because it gets into these weeds, the tax management, the expected returns, a lot of the things that an advisor does that go over and above just having a bigger portfolio. That's just a tiny little, as a matter of fact, portfolio management. Read the paper. You'll find portfolio management is less than a third of the expected added return that an advisor can bring to a person's portfolio.
Yeah. Tax loss harvesting, rebalancing, risk management, those are things that can be done better. I will say this.
It's more personalized, too.
Yeah, I will say this, because I do see this from some advisors, non-fiduciary advisors. Oftentimes they have 20 funds in a portfolio, not because they're trying to build the best portfolio, because they're trying to cover their you-know-what as best they can. So oftentimes people say, well, I want index funds. Oh, you have 2 index funds in there. Oh, I want to own this. Oh, you have all that. And it's a total mishmash, a
hodgepodge.
Yeah, I was going to say that, but I didn't want to steal your thunder.
That's okay.
So that's not right. But a properly
You've done it
coordinated,
before.
designed stealing your stuff, sure.
Yeah.
It makes sense. So, but thank you, Matt, and it's a very thoughtful question. All right, moving on. From David in Marana, Arizona. I think it's the second time we've been in Marana, Arizona recently. But
Don't remember going, but,
it's
I
nice
could have been
place.
drunk.
Beautiful place. Please tell me your opinion on the real estate income funds like Arrived.
Oh, geez.
I'm curious if they are a good investment. Arrived. Have they arrived on?
There are lots of these that are selling to the general public. They're fractional ownership. They're kind of private. Arrived is a company that buys properties, a lot of single-family homes. Holy moly mackerel. And you, along with other investors, own a portion of that home. Like, here's a home, a house, an ugly house at that, with 1,000 investors in this house. I mean, it is just a bad-looking house.
When I go to their website, what's the first thing I see?
Houses.
No.
9%.
9%.
I don't see that
yield.
yet.
That's the first thing I saw on their website. Guaranteed 9%.
Yeah, but here's the deal.
Come on.
Here's the deal. They've got some money. They're saying that their historical yield is 8.5, but they have some properties that are 12. But I'm telling you, look at some of these. This really doesn't even matter. Not all houses go up in value. If you buy a house and a neighborhood turns south, you can lose everything.
Don't you turn south and then go in the neighborhood?
Yeah, if they go downhill, that's
okay.
what if they fall apart.
Okay, but wait a minute. How could they create a 9% yield off a home anyway? Are they
because they're renting it out.
I see.
And they are hoping that it's a total return. So remember, they're also selling these houses after about 5 years.
I see.
So it's a rental return and then a profitability return, and their numbers work really well in a rising real estate market and in a hot rental market, which, by the way, we've just happened to have had for the past several years in most of the country, except a lot of the flyovers. We've had a good market, which allows them to look backward and say, hey, we've paid 9. Can they pay 0? Sure.
And
can
what
they
about
return
liquidity?
Negatives? Yeah.
Can I get my money
they've got
tomorrow?
an answer to the liquidity question. They said, while we expect that you will buy these for the complete term, we make a secondary market. However, you may make less than you expect if you sell in the secondary market, and there are fees associated with it, and could be a terrible deal for you. So they've covered their derriere too. No.
So back to the question.
This stuff is
no.
High return. Wait a minute. Oh, this one ties into the beginning of the show too. High returns mean What? Fill in the
Greater
blank.
Risk, more volatility.
You
In this
know
case, lack
that's
of liquidity.
the truth.
Yeah.
Come on.
So, no, this would not be something we like. And we only looked at Arrived. We didn't look at. I didn't go.
I can tell you all the others are similar in one way, shape, manner, or form.
From Mukilteo, Washington. Right?
As a matter of fact, wait, there was just
Yeah.
recently, I just read about this like in the last week, a real estate deal, one of these kind of deals that turned out, and I'm not saying Arrived is this, but it turned out that it's either horribly managed or was an outright scam, losing people millions. So,
Yeah.
you know, that's the other risk. You don't
That's
know
right. They
these
take your
people.
money. And
They can, but
it's
they
not
can't lie
custodians
online.
anymore.
Yeah, they can lie online.
They have your money. You can't go get it tomorrow. So yeah, good. I like that. Mukilteo, Washington, Barbara. I'm a retired woman, 87 years old. My investments have dividends that last year totaled $16,000. Also, Social Security has readjusted my claim. I received more than twice what I once got for Social Security. I'm assuming somebody passed on and gave you their benefit. I'm guessing that would be the case. I've upped the percent of tax taken from my SSA. Last year, my gross income was $78,000. I'm worried that my income will reach $99,000 at some point and trigger IRMAA, making payments to the IRS each year. But IRMAA worries me. Yeah, because that is the break. I think, isn't it 100 and something where you have to pay more? Your premium goes up at that point. I always forget the numbers because they adjust them too. But
Yeah, I don't.
if your question is, what can I do about it? Not a lot.
You could take less money, I guess, from your.
Well, but if they're paid out as dividends, I don't.
You could get into something that doesn't pay dividends.
True.
I guess you could move your money. But here's the thing. Again, how bad is IRMAA really?
I forget what the monthly
IRMAA
goes up to.
Yeah, here's the deal. I believe. Okay, it's at 109,000 single.
109. Okay.
109.
Yeah.
Okay, so your Part B premium. See, we're quibbling over very little money. At $109,000, your Part B premium
How much?
for Medicare is $203. Your Part D is $0,
Yep.
so you're paying $203. You're at from 109 to 137. She's not going to go above 137.
Doesn't sound like it.
Her Part B is going to go up to $284, $82 more.
Yeah.
Part D will go up to $1,450.
So
Making
a
her
grand a
monthly
year.
increase is it's right just $1,100 a year.
A year. Yeah.
All of this consternation and frustration and scrambling
Anxiety.
for $95 a month. It's not that much.
No. Well,
We
and there's nothing you can do about it.
overreact.
Other
Now,
than you said,
if you
own
make more
something.
than $500,000,
How much is it then?
your extra monthly is $578. But you're making over $500,000. You can afford it.
You can pay it.
You can pay it. I mean, really, what is it with us? We are obsessed. It was Ben Franklin who said "penny wise, pound foolish," wasn't it?
It was.
Yeah. Think about this. You're being penny freaky and pound stupid.
By the way, there's having just arrived off the continent, there's many places that are far worse. I think somebody told me when I was in Italy that only half the people there pay taxes at all. They hide their income. They just don't pay into the system. So. Wow. Okay, we got time for one more
I'm
here?
not going to go there. Yeah. But if you want to go to 30 minutes, we got to do one
Okay.
more.
Portland, Oregon. Yeah, we'll still take a question from Oregon. Tyler, Tom and Don, I found you guys too late.
Oh, no.
I'm in the accumulation phase, and over the last 6 years, started with buying single stocks. By mostly luck, I have a portfolio of primarily tech stocks that is up significantly.
Yes.
Think NVIDIA, Apple, Amazon, Google. Yes, those have all made a lot of money. I've turned off DRIP, which is the dividend reinvestment plan. So hopefully we'll be able to slowly change the weighting of my portfolio over time. You're going to love the question. Guess what the question is?
Taxes.
Yeah. Any suggestion how to get out of this while reducing my capital gains hit? I would be in the highest tax bracket if I were to sell them and do not have enough losers.
Well, don't
off
sell
the
them
winners.
all.
Do it over
Sell
time.
them slowly.
Yeah.
Do
There's
some
other-
tax
there's no-
planning
there's no
so you
trick.
don't bracket creep. That's how you manage it. But
You moved to
I
Nevis
love
or
this.
something.
I do love this. We make a lot of money. This guy made a lot of money. He got lucky and he made a lot of money. We want to keep it all. We want to keep every last cent. I don't want to share with the government. Do you drive on highways? Are there schools in your neighborhood? Do we have an Army, Navy, Air Force, and Marine Corps, and Space Force, and Coast Guard?
Okay, I was waiting for Coast Guard.
I was going to throw them in.
Okay, please.
Are any of those things semi-important to you? If so, pay your damn taxes.
God, you're tough. So, okay. But he's looking for the trick.
There is no trick except planning.
Yeah, something. I'm kidding there, but yeah, there's no other than that. I would have a strategy.
Wait, Grand Caymans.
I forget all the tax.
Yeah, I don't know.
I said
Caymans.
Nevis, but
maybe Nevis and St. Kitts. I don't know.
Don't hike your bracket. You're right. Do as best you can. Take it over 5 years. And by the way, in those 5 years, maybe some of them go down a little bit, and you have some losses to offset.
Okay, wait. Okay, hold on. That comment right there.
Yes?
It's like maybe I'll have less money and I won't have to pay taxes.
As much tax.
Wait.
Lose money. That's a good idea.
Yeah. Oh, yeah. That is a great way
Put it all
to
in a
reduce your
ride,
taxes.
and then you'll be okay. Yeah.
Right.
Lost cost down. Okay.
Yeah, buy Dogecoin. Go ahead. There you go. You want to lower your bracket? Buy Dogecoin.
There's other coins, by the way, that can lose money.
I just like the Dogecoin because it was started. The thing about Dogecoin, unlike all the others, it was literally started as a joke, and it became worth billions of dollars.
There's a politician, I believe, who started with a coin that was worth $165, and it's now worth, I think I read recently, 13 cents or something. So.
Oh, Liberty.
Yeah.
Liberty Financial.
Down
a
lot. So.
Yeah,
and if I got the numbers wrong,
those
I
poor
apologize.
souls who got into that.
Something.
That was on Last Week Tonight with John Oliver. You should watch the a couple of weeks ago. By the way, you don't have these where you live. We do.
Son?
No, Buc-ee's.
No, we don't have Buc-ee's.
No. For those who don't know, Buc-ee's holds the record for the most gas pumps at any gas station in the world. This is
Don's favorite place to visit when he's out on the road.
No, I can't. We went and got gas the other day, and I got to stop doing this. This place, the prices are great. Everywhere else, gas was $3.89, $3.99. At Buc-ee's, it was $3.79. I went, that's a lot.
And you add it up.
Yeah.
20 cents a gallon. Sure.
But it was a madhouse, absolute madhouse. But anyway, that wasn't what the story was about.
You were talking about Buc-ee's because?
Buc-ee's is a bunch of places to fuel your car. They're for cars, not even trucks, just cars. And it's a giant grocery store, actually, snack and junk store. They have a logo of a little beaver. Turned to the side with a little red hat on.
You don't actually have to turn to the side.
Buc-ee Beaver.
Yeah. Shocking.
The founder of the company's nickname was Buc-ee Beaver. So,
okay.
Which he got from a cartoon, by the way. Which
is there a point to all this?
Much more. Yes, because the irony is just dripping.
Yeah.
They've taken to suing every single company in America that has a cartoon animal mascot on their logo. Doesn't matter what it is, alligator, moose, doesn't matter. If it's a cartoon mascot, they're suing.
Got to be expensive.
No, what's happening is these people are all dropping their cartoon mascots because they can't afford to fight the suits.
Oh, they're just giving in to old Buc-ee.
So John Oliver, who's very funny, he's very liberal, but he's very funny. He's won all kinds of Emmys and things.
Sure.
His writers and all came up with the idea of creating a cartoon logo for they have a squirrel that shows up on I'm not going to go there. But anyway, they created merchandise with their cartoon squirrel looking almost exactly like the Buc-ee's logo. And are selling merchandise with this new logo on it called Buck Off. In hopes that Buc-ee's will sue them.
Yeah.
It's a funny bit.
Because you'll sell
it was a funny bit.
More of the whatever.
And in that same episode, they talked about crypto. So anyway, Liberty Financial.
Thank you.
Okay, we're done.
Time's up.
You want to send us questions? Just go to talkingrealmoney.com. and hit the button that says ask a question or record them in the lower right-hand corner with the little mic button. And let's see, what else? Oh, if you want to meet with an Appella advisor just for a few minutes to get some, like, to have somebody look at your portfolio and go, why do you have 20 funds and 33 stocks?
No, it's more than just a few minutes, too. We analyze every security you hold and give you a nice report that shows you how diversified you are, how much you're paying, how much risk you're taking, all those things.
Okay, but
That's
to see
free.
that just adds to the cost.
It's free. I just said it's free. It does not come with a cute little cartoon character, though. So sorry.
I think
about
we
that.
should put them on the cover.
I don't know about Buc-ee.
I don't
but
think
we'll find
Appella wants to
something.
be sued.
No.
I know they don't. I know they actually
Very
don't.
careful.
Yeah.
Very careful.
Anyway, yeah, click on the button that says ask an advisor. You can then have a meeting with an advisor. So there we have it. Who was the guy who wanted us to go long with our episodes?
I forget. One of the questions. Thank
Yeah,
you for all
well,
the questions.
look, you got your wish. We went
Yeah,
long.
there you go. Okay.
Because, we don't care. We're just going to sit here for however long it takes.
Talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.